Trading calendar options. Calendar options, also known as time spreads or horizontal spreads, involve the simultaneous purchase and sale of two options of the same type, calls or puts, but with different expiration dates. Typically, traders buy a longer-term option and sell a shorter-term option. This strategy is designed to exploit the differences in time decay and volatility between the two options. The fundamental concept behind calendar options is time decay. Time decay, or theta, affects the value of options as they approach their expiration dates. Shorter-term options decay faster than longer-term options. By selling a short-term option and buying a longer-term option, traders can potentially profit from this differential in time decay. For example, a trader might buy a call option with an expiration date 6 months in the future and simultaneously sell a call option with an expiration date 1 month away. If the underlying asset remains relatively stable, the short-term option will lose value faster than the long-term option, allowing the trader to profit from the difference. Calendar spreads perform best in low volatility environments. In such conditions, the short-term option's value decays faster, enhancing profits. Conversely, high volatility can erode the benefits of this strategy. Therefore, monitoring market conditions is essential for successful trading. Types of calendar options: short-term versus long-term options. 1. Short-term calendar options utilize near-term expiration dates and are more sensitive to short-term market movements. 2. Long-term calendar options use longer expiration dates, providing more time for strategies to play out but with different risk profiles. Components of calendar options. 1. Long position. The trader buys an option with a longer expiration date. 2. Short position. The trader sells an option with a shorter expiration date. 3. Strike price. Both options have the same strike price. 4. Underlying asset. Both options are on the same underlying asset. Just a quick reminder to please hit the like button and subscribe to the channel for more content like this. Also, visit us on the web at www.investmentees.com and use code BLOG to receive 25% on your next purchase. A single calendar spread involves buying one long-term option and selling one short-term option on the same underlying asset and strike price. Double calendar spread. This strategy involves creating two calendar spreads at different strike prices, providing a wider range of potential profitability and hedging. A diagonal calendar spread is similar to a single calendar spread but uses different strike prices for the long and short options, adding complexity and potential for higher returns. Calendar spreads capitalize on the principle that time decay, theta, affects options differently based on their expiration dates. The short-term option, which decays faster, is sold to fund the purchase of the longer-term option, which decays more slowly. The premium is the price paid for an option. In calendar spreads, traders look to benefit from the decay of the short-term option's premium while maintaining the long-term option. Implied volatility, also known as IV, is a measure of market expectations for future volatility. Calendar spreads benefit from increases in IV, as it typically raises the premium of the longer-term option more than the short-term option. Time decay, or theta, erodes the value of options as they approach expiration. Calendar spreads are designed to take advantage of this decay, particularly in the near-term option, which loses value faster. The profit from a calendar spread typically comes from the difference in the time decay rates of the options. When the short-term option expires, the long-term option still retains value. If the underlying asset's price is close to the strike price at the time of the short-term option's expiration, the profit can be maximized. To construct a calendar spread, follow these steps. 1. Select the underlying asset. Choose an asset with predictable volatility and price movement. 2. Choose the strike price. Typically, the strike price is set near the current price of the underlying asset. 3. Determine expiration dates. Decide on the expiration dates for both the short-term and long-term options. 4. Establish the spread. Buy the long-term option and sell the short-term option simultaneously. Calendar spreads example. Consider a stock currently trading at $100. A trader could establish a calendar spread by buying a call option with a strike price of $100 that expires in 6 months and selling a call option with the same strike price that expires in 1 month. Strategies for trading calendars. Neutral market strategies. In a neutral market, Calendar spreads can generate profit from time decay without relying on significant price movements. Bullish strategies. For a bullish outlook, use call calendar spreads. They benefit from stable or rising underlying asset prices. Bearish strategies. Put calendar spreads are suitable for bearish market conditions, allowing profit from stable or declining asset prices. Theta or the time decay. Theta measures the rate at which an option's value decreases as it approaches expiration. Calendar spreads leverage theta by selling the faster decaying short-term option. Vega or the volatility. Vega measures sensitivity to changes in implied volatility. Calendar spreads benefit from increases in volatility, which enhance the value of the long-term option. Delta, price sensitivity. Delta measures the sensitivity of an option's price to changes in the underlying asset's price. Calendar spreads are generally delta neutral, meaning they are not significantly affected by small price movements in the underlying asset. Gamma, rate of delta change. Gamma measures the rate of change in delta. In calendar spreads, gamma is typically low, indicating that the delta does not change dramatically with small price movements in the underlying asset. Conclusion. Calendar options, also known as time spreads, involve buying and selling options of the same underlying asset with different expiration dates. Typically, traders buy a long-term option and sell a short-term option. This strategy benefits from the decay of the short-term option's time value, leading to potential profits. This options strategy offers a versatile and relatively low-risk strategy for traders looking to capitalize on time decay. By carefully selecting the underlying asset, strike price, and expiration dates, traders can construct effective calendar spreads. However, it is crucial to remain aware of the risks involved and employ strategies to manage them effectively. With proper planning and execution, calendar spreads can be a valuable addition to any trader's portfolio. Thank you for watching.